Crystal.
Hello, how are you? Good to see
I'm good.
you.
I'm good. We have a lovely rainy-ish day out here, which means I get to sometime this afternoon slash evening go to a cafe and watch the rain come down. That's going to be very cool. And get to hang out with you for an hour. So that's cool. How are you doing?
I'm good, but I think I'm frozen.
Oh, you
Let's
are
see.
frozen.
I am
Yes.
frozen. Hold on. Let me see if I can get me back up.
Yeah. Thawed,
Let's
as it were.
yeah, I'm fraud. Hold on. Let me see if I can get me back up. You may pop in and I may pop out. Let's see
Oh, okay.
what we do. But let's see. Let's see if I can shut me down for a minute. Ah,
Are you going to
all
have
right.
to
Yeah, I'm
go
gonna
and
come
come
out and
back?
come back. Yeah, I'm gonna go and come back.
Okay. So go and come back, and we will we'll read your bio as you go. How's that?
Ah, no.
Okay. Ladies and gentlemen, this is Jevon Thomas of BTA Advisory Group and Platinum Wealth Strategies. And I'm going to be hosting this show with my friend and colleague, Crystal Mitchell. You see the picture of her on the screen there. She's having some technical difficulties. So I'm going to go ahead and read her bio, and then we'll see if she can come back in. So please allow me to introduce Crystal Mitchell. She is a business coach and consultant. She's also the CEO of Mitchell Business Solutions. She's a co-director of Recycling Black Dollars. She's the co-host of The Business Zone with Crystal and Gilbert, a other weekly online broadcast show. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Please help me welcome my friend and colleague, Crystal Mitchell, to Conversations on the Patio.
And I
Okay.
think I'm still frozen.
Oh my goodness. Frozen, but still kind of, but we can hear you.
Okay, well, hello everyone. Sorry, I'm frozen. My internet decided it wanted to be crazy today, but glad to be here.
Good deal. Good deal. Well, we get to see your lovely shining face. I
Okay,
think since we still have you on audio, you can still participate. Does that feel good?
that feels good. That feels good. As long
Okay.
as you can hear me.
Okay. So I never know. That's a really lovely smile that you have there. That's a rent
Okay.
pattern. So I'm really excited about today's little broadcast idea that I came up with. It's loans, credit cards, and homes versus retirement plan contributions. And the reason I'm excited about this is because there are a lot of people that have a lot of things going on in their life, but this is one of them. That is, how do you prepare for the retirement when you have so many other things that you need to take care of, right? Why should I, as a participant, put money in my retirement plan when I've got some big bills out there to take care of? And I think this comes on the heels of what I was listening to this weekend with regard to what's going on in the housing market, what's going on in our economy, and some economists are suggesting that we're still looking at third or fourth quarter with regard to a recession. Some are saying it's not going to be that bad, and that the housing market is going to be a positive thing here. It's not going to be going down as much as we thought. So we don't know. I can tell you that things that happen out here in California are not necessarily the way they happen in other places of the country. So we have to be aware of that. How you doing, Crystal?
I think I'm okay, but I think I don't know if I'm coming back as a human being, as
Okay.
as a weekly human being.
All righty. Well, please jump in. I'll try to leave some space for you to make a comment. That's
Okay.
as you know, that's pretty difficult for me to do. So I'm probably going to look for
Okay.
some kind of cookie afterwards or reward or something. So, what do you think of our topic?
I love our topic, and it's so interesting because yesterday I was talking to my girlfriend, and she works in corporate America, and she's just started about 2 years into her company, and so she was just commenting on whether or not she was going to start contributing to her 401k, because prior to this year, her mom had passed away, so she didn't have any discretionary funds to do that. Now she does. And
Ah,
so she was saying, maybe I should wait. And so I was just having that conversation. And she's 62. And I was saying, well, I don't know if waiting is a good time, because she was concerned about the recession. And I said, you're at 60, or you're turning 62 in March. I don't know if waiting is a good time for you. This is a good thing for you to do right now, because you can
exactly.
wait to next year. But she was the same thing. She was saying, do I wait past this recession? And so I made a comment to her that I had heard just the other day that they had indicated that Warren Buffett has lived through 14 recessions. And not one time during those 14 recessions did he wait. Did he stop investing? Did he stop doing anything? And if he had, his $85 billion net worth would be less half, because he did not let that intercept his plan and his strategy.
Well said. Well said. And Warren is the person that I think we coined the phrase when the blood is running in the streets, right?
Mm-hmm, mm-hmm.
That's when we jump in. So that's true for him. I have a little bit of background noise here. We've got someone setting up a photo shoot for me, so I hear it a little bit. So if you do, please forgive me. We're on a little bit of a tight schedule.
Okay. No, I don't hear anything.
Okay, good. So I think Warren is, as the guru would be of value investing, he's spot on. I totally agree. The time for people to start investing in the 401k is yesterday, right?
Mm-hmm.
You definitely don't want to wait. So hopefully she experienced that. Hopefully you ended the conversation with not waiting. Did she say why she wanted to wait?
She just wanted to wait and see what was going to happen in the third quarter, and that since they were calling the recession, and she didn't want to lose her money. And I guess the controller of the company had indicated that in 2008 she had pulled out all of her cash at that time, and put it in pulled it out and put it in a bank account. And she was able to preserve her 401k, whereas others lost their money. And I told her, I said, but this recession is going to be different than the 2008 recession. And we can't, and what happened then is different now. So, and at that time, that was 14 years ago, had definitely time enough to recoup whatever was going to happen. I said, but you're 62. So, not that you're going to retire in 65, but you won't have time to recoup. So, just leave it in there. Just put it, start. Got to start.
You gotta start.
You got to start. And so that was my advice. You got to start.
That's great. I'm so glad that you went that way. I think we'll get to our topic. This is sort of leading into that. So thank you for that, for that segue. That's really good. But let's talk a little bit about waiting and when to get in. And of course, me being a financial advisor who specializes in 401k plans, of course, I'm going to say get in, right? But if I could set that aside, and we just talk about how the market works. And then I want to say prior to that, let's talk about what's actually going on in the minds of people that are investing in the retirement plans. We've been sold a myth that is horribly incorrect and unjust and unfair by the financial services industry. And that myth, amongst so many other ones that we've got to deal with, that myth is that, number one, things that are going on now will continue to go on that way. That is to say, if the market is going up, it's going to continue to go up. If the market is going down, it's going to continue to go down for some foreseeable future. The problem is that's just wrong. The way the market goes is it goes up and it goes down. And nobody really knows exactly when it's going to happen until after it's happened. So the very fact that we're going to be able to figure out when the best time to get in, according to what's going on in the market, the very fact that we can do that is a horrible, horrible misnomer. And we're always going to be disappointed. So with that myth busted out of the way, what do? You get in and you come up with a strategy that involves and takes advantage of market upturns and downturns. And that is, you become what I call a long-term investor inside your 401k plan. Now, outside your 401k plan, if you're dealing with your financial advisor, they have a strategy, that's great. I'm sure that's fine. But inside your 401k plan, things are just a little bit different. Number one, we know that most likely you're going to take the money out and you're going to do something with it. That's a bit different than your long-term plan, right? So on a 401k plan or a 403b plan or any company-sponsored retirement plan, it is a benefit that the employer gives you. And when you stop working for that company, the benefit kind of comes to an end, right? So with that in mind, how do we handle our retirement plan? Well, number one, we know that the market's going to go up and down. Number two, we know that our contribution phase is going to come to an end. And number three, we know that it's very difficult for us to time when to get in and when to get out. And most likely, we're going to mess that up. We're not going to be able to get that, right? We're going to put money in and we're going to wish that we put it in before when we saw the results before. But the 401k system, the benefit designed for your employer to offer you is designed so that you cannot time the market. That is, you cannot figure out when you should get in. It just doesn't work that way. That's one of the reasons why it's such an exciting place to be, is that you cannot figure out when to get in, and you're always going to wonder if this was the right time to get out. Now, that's a good thing for your friend who happens to be in her 60s, right? This is a great time to get in. The market is going up and down. Let's take a look at what happened a little bit back in 2008. In 2010, S&P 500 gained more than 16 points. So all of those monies that your friend said she lost out on and her money going down, all of those monies that she could have been putting into the retirement plan, and I don't know if she did or she didn't, but let's just say that she didn't. So all of those contributions that she could have put in, where she would have bought them cheap and would have sent a great windfall over in 2010, she may have missed out on them if she didn't make a contribution. Now, I will also say, let's say she played it right. Let's say she pulled money out in 2007 before the market tanked, and she put that into her bank account. And let's say that she did that over several bank accounts because she had more than $250,000, which is FDIC insured. I'd say, smart lady, if you can figure that out. But you certainly don't want to depend on your bank account for taking the amount of risk that's going to grow your portfolio in a significant way when you compare that to putting your money into the market. So I would say, number one, for someone in their 60s, get in the plan. Get the tax advantage if that's what you're working for. Get the employer match if that's what you have an opportunity for. Start saving. Every little bit hurts. So let's do that one. Number two, we don't know when it's going to go up. We don't know when it's going to go down. We do know that that's going to happen. We do know that we need to devise a strategy that will allow us to take advantage of that. So let's do that. And that's what we call being a long-term investor with the right mix of stocks and bonds, the right asset allocation, reevaluate and rebalance on a regular basis, or find some entity like a target date fund that's going to do that for you. And then number three, understand, and I think this one is really kind of tough, that the market is going to change. It's not always going to go up. It's not always going to go down. It's going to change. So as a rule of thumb, staying the course is a really, really good strategy, as long as you do everything else. So that's pretty much what I have to say about that. What do you think? Oh, I lost you, Crystal. Oh my goodness. Okay. Come on back in when you get a chance. All right. Okay, so let's go on to our topic: loans, credit cards, homes versus retirement plan contribution. I wanted to talk about this today because, as I was explaining with Crystal, there are a lot of people that are struggling with, where should I put the money? Do I have enough money to buy the house and make a contribution to my retirement plan? Should I pull money out of my retirement plan to purchase the home? Where's all this money going to come from where I can actually pay the loan, pay off my credit cards, pay for the home, and contribute to the retirement plan? Something's got to give, because I can't do all of it. And I would say, you got to do all of it. That is the deal. You have to do it all. You have to do it all gradually. Sometimes you've got to make a decision and a commitment that's not something that you like. But when it's all said and done, you got to do it all. Okay, so let's take a look at it. How do we break this down? Okay, let's talk about those loans. Should you avoid starting contributing to your 401k plan until after you pay the loans off? Many participants have said the exact same thing to me, and I say the exact same thing to them. It depends on that loan. Yeah. I mean, let's get right down to it. Investing in yourself is a good thing. So student loans are a good thing. I would never want to say to someone, don't go to college until you get that 401k or you get that loan paid off. I would never want to say that. But if we take a look at that loan specifically, and I see Crystal's trying to come back in. If we take a look at that loan specifically, if you're going to have that loan for the next 30 years, you should start putting your money into your retirement plan. Find a way to put some money into there. Now, most financial advisors suggest that you contribute 10 to 15% of your income. You may not be able to do that because you got that loan out there. Maybe you can put 5% in. Maybe if your company has a match, you could at least get the match, right? You don't want to leave that money on the table. So when it comes to a loan, if it's only a 3-month loan, you're going to pay it off, I'd say pay it off. If it's only something you need one more paycheck to get rid of, I'd say do that. If it's going to be a 10-year loan, a 5-year loan, maybe even a 3-year loan before you get to pay that off, I'd put the money into your retirement plan. I'd get that started. Maybe it's not at the amount that you'd like it to be, but time in the market counts, right? Buying cheap counts. And hope that you get into the market at a time where the investments are extremely low, so that as you get older, you don't have to take as much risk to buy into the plan, to buy low. And then you don't need it to be super high, that is the market, before you can reap some great rewards. So you got a loan. If it's a little short-term thing, a couple of months, all right, I see taking the money that you're going to put into your retirement plan off the table and paying off that loan. But I mean, pay it off. It's gone. Okay. Credit cards, I'd say same thing. If you can get them paid off, then I'd definitely pay them off. Crystal is back.
Hello.
Hey, there you are.
I had to come all the way out. I heard you, actually. I went to LinkedIn and I heard you.
Oh, good. Okay, great. Okay, so that's the credit cards and then that's the loans. Let's talk about home ownership. That's a big deal. I mean, living in this country, people want to buy a home, you know?
Yes.
I mean, I had a home once. I liked it. I mean, it was expensive, but I did. And I intend to buy another one. So preface this with, we don't even know what's happening to the real estate market. And out here in California, things can look a little bit different than they do in the rest of the country, right? Mm-hmm. So I was just reading an article this weekend suggesting that this economy is not going to be that bad, that the home ownership piece of our economy is going to be just fine. It's going to be sort of stable. How about that? I don't know. I don't know. That's not me. That's not me projecting. I don't know.
I heard it was going to be in certain economies in the state, San Diego, San Francisco, the Bay Area, those areas. And I think it was more the tech type areas that were going to be affected more than, say, the Los Angeles area.
Okay.
Yeah. And I think I'm going to attribute that to that those areas, their industries are more tech based, and the more tech based industries are going through some downsizing. I think we
Yes.
talked about that a little bit last week. And I think that's why there's probably more of an adjustment in those areas. But I also think I went to a meeting this weekend with Supervisor Holly Mitchell's office, and it was talking about homelessness. It used to be that when you got to retirement age, you thought about downsizing your home.
Okay.
And moving out of your family-sized home into a condo, right?
Yes.
Into a which would be less maintenance, less cost. And usually when you sold your family-sized home, it helped you put away a little more money, right, into your savings.
Sure. Yeah.
To help you with your retirement. But I don't know, because there's not as many condo developments being built, especially in California. I don't know about anywhere else, but I live in California, so I have to work with California. There's not as many properties being built that are condos and townhomes, right? It's mostly apartments. So apartments don't help you build equity, whereas you would now have some places to pull money from that can help you in that. So I think there's that's some thought processing. There's some thought processing to go into that. So if you sell your family home, especially in the California marketplace, buy a condo, you could live out your retirement quite well, plus your retirement, right?
Right. Yeah.
Yeah. You could be all right.
There you go. Right. And you got to think about that, what's going to work for you.
Yeah.
So I think you're right. I think if we think from a broader perspective, we still have a demand for homes out there. We still have less homes to put people in, and we still have a problem with people being able to get into the homes. So that's one of the reasons why we call it a dynamic economy. There are a lot of things, a lot of players, and a lot of interest. Can we call them stakeholders, perhaps, if we go corporate speak, that are affecting what's going on. So it's not a simple answer. A lot of things are going to happen. But the point still remains. Should I start my 401k plan or buy a home first? Right. And then the question is, if I decide that I want to buy a home and I have a 401k plan, should I take money out of that 401k plan and invest it in the house? That is for the down payment, right? Because that's what stops a lot of people is that down payment. Or should I take money out of that retirement plan and make that house more presentable so that it's a lot easier for me to sell? Whew. Well, I see you. Yeah, Jevon, what you gonna say now, right?
Right, exactly. And I see the wheels turning.
So I'm gonna say you should never pull money out of your retirement plan if you can help it until you get to the end. I'm going to say that. I'm going to say you have the option of pulling money out of your retirement plan, depending on the plan, not always, but depending on the plan. And that's important because all plans are not the same. So the plan at your company is not necessarily going to be the plan all over for every company, especially on this point, which what we call a hardship withdrawal. There's only a few of them. And one of them is pulling money out of your retirement plan, not paying a penalty for that, and investing that in your home. Is it always a good investment to have a home? I would say yes. Is it always a good investment to take money out of your 401k to pay for that home? I'd say no. Emphatically no. However, I'm not your spouse and children that really, quote, need a home and a backyard to play in. I don't have that. I don't have that. I don't have that pain, right?
Right.
So I would say if you can avoid taking money out of your retirement plan to buy a home, if you can avoid that, please do. If you can avoid taking money out of your retirement plan to stave off the sheriff because he's coming to your home to eject you, um, or to stave off the sheriff because you're going to lose your home. If you can do that, then great. That would be the way to go. But sometimes you don't have enough money outside of your retirement plan to do that. Sometimes that's it right there, right? One of the things I always preach is alongside your retirement plan to build up 6 months or 8 months worth of bills and put that someplace so that just in case something happens, you can pull from that. I'm pretty famous about saying that. And I think we should do that. Now, some people are going to say, should I wait to start my retirement plan until I have that? Oh, no, don't do that. We just have to make sure that we put a little bit less in some places so that we can get all these buckets taken care of, because as soon as something goes wrong, you're going to want to have that bucket. You really are. So the answer to the question, should I pull out money from my retirement plan and use that money to purchase a home? I'm going to say no. I'm going to say, in many plans, you can. And I'm going to say, in many situations that I've seen, people do. And then they take that money out, they pay the taxes on it, and they go back to working and putting that money in their retirement plan. But again, I got to say, time in the market is a good thing, right? It's a good thing. So that's not very good advice, except you got to do what you got to do.
Right? True. And then, with the economy so volatile, people, you're right, people have some hardships, and the recovery time, we just had the pandemic, although we did have money, so that was really a good time. People did have a lot more money flowing during the pandemic than we had in 2008. 2008 there was no money flowing. Nobody was giving you anything in 2008. But
I think we got one payment in 2008. Didn't we get one check in 2008?
Did we get one check?
I think we got a check there.
Okay, but there was quite a bit of money flowing.
It wasn't like it was during the
the pandemic. You had a lot of little buckets. You could have had your 6 months of emergency fund. You could have had your this fund. You could have had your pocket for your 401k fund there. Yeah, and your investment fund. You could have had a lot of, but that's not what happened. Not at all. Paid off your credit cards. There was a lot of things that could have happened during that time frame. That is not what happened. But it was actually some recovery time that could have taken place right there. But unfortunately, people don't understand how to manage and navigate the strategies of money, and that's why we tend to find ourselves in these places that we're in.
It's true. And again, I gotta say, when the blood is running in the streets, that's when you get in, right? So when you see the market depressed, 2008, 2009, market's depressed, understand that it will go back up. Understand this is when I make the money, right? I mean, there's an analogy that I use that doesn't work, but I'm just going to put it out there for yourself, and maybe you'll have some grace for me. And that is, when do you make money on your house? Do you make money on it when you buy the house, or do you make money on it when you sell the house? Right, so if you sell that house for $80,000, if you buy the house for $80,000 and you sell it for $120,000, then you made $40,000 on your house. Make sense? Right, now, what if you buy that house for $40,000 and you sell it for $120,000? How much have you made then?
You made it when you sold it.
Exactly. But how much did you make?
And you made the $60,000 of it, right? You said you sold it for 180?
120. Same
120?
price. Yeah.
Yeah.
But you bought it at 40 instead of
At
80.
40. Yeah. So you made it for 100. You made 100 and
You made $80,000.
80,000 on it. Yeah, 80,000
Right?
on it.
Okay. So what would you rather have? The $40,000 that you get to do something with, or the $80,000?
The 80,000.
All right. So the way you get the $80,000 is you
You had
buy
to buy
cheap.
cheap, right? You have to buy
Now, if I
cheap.
were a real estate person, I would say they're not making any more houses and you need a home. As a financial professional, I say that's what salesmen do. As a person who sells financial instruments, we always say that. But as someone who is going to call out other people, except for me, I would say buy low and sell high, which, right, every time you can, right? So
Right, exactly.
when do you buy that home? Think about when you need to buy the home, right? Don't buy something that you don't need.
Yeah. Yeah.
Unless it's
that's
an
true.
investment property that's going to give you money. Because, right, a house, in my opinion, is not an asset unless it's paying you.
Yeah.
Right.
Exactly.
Right. Right.
But most people don't recognize that. Most people
They
think
don't.
it's my house. No, it's not your house because you're paying for it. You're paying the bank for it. It's actually the bank's asset, not your
There you go.
asset.
It's their asset. They're
It's
making money
their
off of it.
they're
You're
making
paying.
money, right?
Yeah.
But if you buy an income property and somebody's paying you, now you're
that's
making
your asset.
your
There you
asset.
go.
Yeah.
That's a very good way to think about it. Thank you for that help and support. So, can you afford to buy the house? Should you afford to buy a house? Should you buy a house? I'm going to say for most Americans, that's a good thing to do. When we think about the amount of money you need for retirement, a house figures hugely into that mix. And we say, and we used to say, you need to have about 80% of your retirement income needs to be, you need to derive 80% of your take-home pay. Let me put it that way. You should derive 80% of your take-home pay from the assets that you've accumulated. That would be Social Security, your retirement portfolio, any savings that you have, any business ventures, whatever it is, all that huge thing that ought to generate, not be, but generate 80% of your current take-home pay. And when that happens, retirement ought to be okay. Unfortunately, that's wrong. Yeah, that's wrong. Because we found out that people who have retired, and especially now, they do things with their retirement money. They don't have the good sense to die at 65 like they're supposed to do. When we started that Social Security thing. They're living dramatically longer than that. So now, since they're living dramatically longer, they're doing things. They're traveling. They're visiting grandkids. They're starting organizations. They're going to clubs. They're playing tennis. They're getting healthy. They're just more active and doing more stuff.
Right.
So now they're living even better than they did before they retired. Oh my goodness.
Yep.
All right. So now we say these things, all of this, Social Security, your savings, your pensions, your 401k, your business ventures, everything that you've got, your whole portfolio that comes into providing you income, that needs to generate about 110 to 120% of your pre-retirement income. Because you're not going to be sitting around in a chair watching TV all day. You're going to be out there doing stuff and making things happen and changing people's lives. So that is after you paid off the house. Right? So you got no house payment, because for a lot of people, that's sometimes 25 to 40, 50% of their income is going to that house, right? So let's get rid of that. I've always said, let's get rid of that house payment. Living Well, we still have property tax and that kind of stuff, but we're not spending that a couple of grand. Oh,
every
if I
month.
live in California, we're not spending that $4,646,000 a month on the house payment. So, so with that, then after the house payment is gone, now you've got 115, 120% of your pre-tax income coming to you, including Social Security. Now we say, okay, that's what that ought to be where you should be there. You should be there with regard to your retirement savings. So when people say to me, am I in the right spot? How much should I have? I say, you know what? It's not that simple. There's some dynamics going on there. What's your health like? Do you have a house payment, which is like the thing of the show? Do you have a house payment? Can you pay that house off? Do you need to downsize so you don't have that? Do you need to bring on some renters so they make the house payment for you? Whatever it is, don't have that house payment when you retire. That's the deal right there.
Yeah.
That's what you get to.
Yeah.
So should I pay off my house? We'll get back to the end. Should I pay off my house in retirement so I don't have that bill? Now, a couple of people have laid that before me. All right, Jevon, here's the deal. I'm going to retire in the next 2 or 3 years. I'm going to get out of this house and move into something smaller so that I don't have a retirement bill. Or I'm going to pay off my house within the next 3 to 4 years of retirement so that I don't have that for the rest of my life. What do you think of that? And Crystal, I got to say, if you're going to pay your house off, if you're going to retire at 67 and you're going to pay your house off at 70, maybe that's not a bad thing to do. I would rather that you retired at 67 and got your house paid off, but working a couple of years longer than 65, especially now that we're going to live to 90 some odd and maybe even 100. If you can get a couple more years in, your Social Security numbers go up and you're able to get rid of that house payment or some of those credit card bills or whatever it is. I kind of like that idea. I kind of like going into retirement as free from debt as possible.
Oh, I think that is just on the mere fact that you are relieving the stress of being in debt and worry, because at least that is going to reduce your potential health issues into the future, because that's going to bring on more health issues as well. So, and then that will free you up. You can then, release that, and whatever monies you're making on your side, your new second act. Now you can start creating some new second act income, and then that's what you're going to be using for your recreation and things to make your life happy, and and not incurring new debt, but making your life happy and increasing the longevity of your life. I think that's a much better plan.
I like it. I think you're absolutely on point. I like it. Yeah. I mean, after all, we all like happy grandparents. That's right? I mean, you can't take the kids over to grandma's house and she's stressed out. No, we don't like that. We want some happy grandparents.
Right. We want the happy grandparents. The grandparents that's cruising every 6 months.
Yeah. That's the grandparents right there. That's their job. Be happy.
Right.
Okay. So there's my opinion there for waiting or for buying a house or for contributing to your 401k plan at the time that you have a home. All of those things, paying off those loans, those credit cards, all of that stuff wrapped up into this is a long-term investment. The earlier you start, the better. The later you start, the worse. Don't time the market. It doesn't work. And here's the deal. I'll leave you with this. Every person I know that does well in the market has failed many, many a time before. We only hear about the people that make it and make it big. But they've lost it big. I can guarantee you. If you can find someone that has never lost it in the market, they always hit it right, then I don't know, to do what they do, I guess.
Mm-hmm. Mm-hmm.
But they're not giving that away for free, I can assure you.
No, no. Well, I think that goes along with that, right? But I think it just requires taking, planning it. It's not, it requires planning and thinking out what you really thinking, sit down and planning what you want your life to look like on the other side, not guesswork, not making an assumption that, okay, this is what it's supposed to look like, but no, but how do you make sure it is going to look like that, right?
You can't do that without planning,
You got to
and
plan
if you
it,
can do it with your spouse, even better.
and your whole family.
And your whole family, most definitely.
Your whole family. You got to plan the whole thing. So, what is the better? What are the better options? And it's so funny. This weekend, I was at this conference or this round table kind of fire chat kind of conference. And I was sitting with these ladies, and we were talking about, what the future looked like. And these ladies all worked in. These individuals all worked in government. Government type jobs, and they were worried about their homes. They were worried about once we retire or we leave this planet, and they weren't comfortable leaving. Like, what the heck is going to happen to the property that I've worked hard for, the homes that we've worked hard for? And one lady said, she just straight out said, my kids are knuckleheads, I know they're going to lose my house.
Oh no.
She said, I know they're going to lose what I worked hard for.
Yeah.
And I was giving them some insight and how they could go about doing that, how to save it. And she's like, she was just worried. She was just like super worried. I just know they're going to lose it. And we haven't planned. We haven't taught them nothing. They don't know nothing. And one lady's like, yeah, my family, we just knew, right? From childhood, we go to college, go to high school, go to college, buy, work for a good job, buy a house, go to, this and da. We had a plan. These kids don't have plans. And I was laughing, but so true.
Yeah, that's what we call freedom.
Right. But they had a plan, but they didn't pass that on to their children to continue on the legacy of the plan.
Indeed.
So I was chuckling over there. So when I left and I was giving them some input, and one lady says, do you have a reading list? Because you seem to have a lot of information. Can I have your reading list?
You should have told her you have a Jevon.
I know. I said so. I do have a reading list, so I have to send all of them my reading list, my book list.
There you go.
But yeah, gotta have a plan, people. Gotta do some reading and have a list. Have a reading list and teach your children.
Okay. Well, we have a few minutes more. So how about if I read your bio again and then you give us the last word? Okay, here we go. Everyone, thank you for joining us. I'm Jevon Thomas. I'm a retirement plan advisor. I help people with company-sponsored retirement plans. And my friend and colleague, Crystal Mitchell, has been kind enough to join our broadcast, grace us with her business acumen. I'm going to read her bio, and I'm going to give her the last word. Here we go. Please help me say hi again to Crystal Mitchell. She is a business coach and consultant. She's the CEO of Mitchell Business Solutions, co-director of Recycling Black Dollars. She's the co-host of The Business Zone with Crystal and Gilbert, that other weekly online radio show. She is an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Hey there, Crystal Mitchell.
Hello, Jevon. Thank you. This is a good conversation because these are the kind of conversations we have to have. It gets people thinking, and it gets people to, really pondering on what the future looks like. And I know we have everyday walk of life challenges, but we have to look forward. We just can't walk up one day, wake up and say, hey, oh my God, I'm 2 years out from retirement. What do I need to do? No, we have to be working toward that, and it can't be a surprise. We already have to have plans in place before we retire, during the retirement process, and after retirement. We are all living much longer than 70, 80, 90, and we want to live good lives, and we don't want to be stressed. And if we can help it, we want to live healthy lives. There are people living to 80, 90 year old, having good lives, but we don't want to be struggling financially during that time. So it requires us to plan. And I know people hate to plan, but we have to, and we have to know that during that process, there are things that happen, challenges happen, recessions happen, crises happen. So we have to include that in the plan, and we have to not just plan ourselves, we have to incorporate our families, our spouses into that plan. So that's what we're going to say. We're going to end this up with, you got a plan.
Well said, Crystal. Well said. With that, I'm going to bid you all good day.
And bye-bye, everyone.